So sometimes early in our accounting education, it's easy to get confused about what T accounts are. T accounts are a shorthand way that textbook authors and accountants in the real world look at transactions to see what the debits and credits are doing and to see what the balances would be in certain accounts. So remember, there are 9 steps in our accounting cycle. We analyze transactions to see if there's something for us to record. If there is, we make a journal entry with debits or credits. And then we have a whole bunch of data, but it's listed in chronological order and it doesn't help us very much. So we reorganize it by posting it to the individual ledger accounts. So for example, the owner invests $10,000 cash in the business. We debit cash, credit owner's capital. Somebody pays us in advance for some work, so we debit cash for $1,200, credit unearned service revenue for $1,200, and we pay rent for the month of October by debiting rent expense, crediting cash. So imagine I had dozens and dozens and dozens of these, and my boss walks in and says, "Russ, how much cash do we have?" I would have to say, "I don't know. I haven't posted yet. I haven't reorganized the data yet into a more user-friendly format." When our computer software posts it, it probably looks like a traditional general ledger account here. October 1st, a reference means that it came from journal page 1, general journal page 1. There was a debit to cash, so now the balance in the cash account is $10,000. That second journal entry was on October 2nd. We received $1,200 on unearned revenue, so we make a notation that it came from page 1 of the general journal, another debit to cash for $1,200, and then we keep a running balance out here. That's the beauty of this, is that there's a running balance out there in that last and final column. But in accounting class and in the real world, you really don't always need to know the running balance. You're just trying to figure out what's happening in a particular transaction, and so you use T accounts as a shorthand way. So in this example, we'd have a $10,000 posting to the cash T account on the left-hand side because debit means left. We'd have a $1,200 posting for the cash from the unearned service revenue, and we'd have a $900 credit. And we should put little dates out here if we're being precise to talk about the date that that transaction occurred. And then if we wanted to strike a balance, we'd add up all the debits, subtract all the credits, and we'd come up with a balance of $10,300. Since it's a debit balance, we'd write it on the left-hand side. And to show that we struck a balance, we draw a line here. Yeah, of course, if this were the T account for unearned service revenue, it would have a credit balance over here. If this were the T account for owner's capital, it'd have a credit balance over here. So T accounts are a shorthand way to look at life. They're a great way to look at life. It's black and white, debit and credit, left and right. And hopefully you get used to them pretty quickly because we use them all the time in accounting.